Welcome back to BullionIQ, your home for simple and real crypto and finance understanding. Today's topic is serious, and I want you to pay attention because what is happening behind the scenes in the banking world is not small news. It is something that can shake the global financial system, and it directly connects to crypto and XRP. We are talking about the shadow banking crisis. I know it's the weekend, so I will keep the tone simple and clear, but this information is too important to ignore. If you think the recent crypto shakeup with heavy liquidations was huge, wait until you understand what is going on in the banking system. This is not just theory, it is happening right now. The first thing you need to know is that cracks in the financial system are growing. Private credit markets, private equity funds, and small regional banks are all under pressure. Most people only hear about big banks like JP Morgan or Bank of America and think the system is safe, but the truth is, the banking world has a second layer, a shadow system of lenders, private credit firms, and smaller banks that take on risk quietly. These are the weak points today. When the economy slows, when loans fail, and when debt piles up, these shadow players start breaking first. That's exactly what we are seeing. And the scary part, even the CEO of JP Morgan, Jamie Dimon, said something that should make everyone think. He said, when you see one cockroach, there are usually many more hiding. That means if one bank or lending company shows cracks, many more will follow. This is not panic talk. This is reality from the top people in finance. Big banks have safety nets. They get rescued, supported, protected, but small regional banks, they do not always get saved. They get sacrificed. When the system wants to protect itself, it lets the weak players fall. And what happens when they fall? Giant investors swoop in and buy assets for cheap. They love these moments. They call it buying the blood in the streets. While everyday people panic, big institutions get rich. Our job here at BullionIQ is not to panic. Our job is to see clearly, understand early, and position smartly. We already see real examples of problems. Auto lending firms in the shadow credit sector started failing. Real estate loans are collapsing. Homes bought at inflated prices are now going into foreclosure. One example in Michigan shows a bank giving a $21 million loan for an apartment complex that is now worth only $1.5 million. That is a huge loss. In Baltimore, over 700 homes tied to private lending are falling apart financially, with millions in unpaid bills. These are not random mistakes. These are signs of deeper weakness. So what does this mean for us? It means the debt bubble is shaking, and when debt breaks, money runs towards safety. In the past, safety meant only gold and cash. Today, safety includes crypto, especially assets built to support real financial infrastructure like XRP. When banks and lending systems struggle, when trust falls, the world looks for a new system. That system is blockchain-based finance. That is why this moment matters for XRP. Not because of hype, but because the world needs faster, safer, transparent settlement, and traditional banking is failing at that. Before we continue to deeper parts of this story, ask yourself one question. Do you think small banks and private lenders can survive rising rates, falling real estate values, and high debt? Think about it. And while you do, make sure you are subscribed to BullionIQ because we do not talk noise here. We talk truth, opportunity, and long-term vision. Tap like, share this with someone who needs clarity, and stay with me. This crisis is real, but knowledge gives power. We are early, we are aware, and we prepare. Ready for part 2? Now that we understand the cracks appearing in the shadow banking system, let us go deeper into what is quietly happening in global finance and why this matters for crypto, especially XRP. Many people only look at the price chart and think everything is fine if markets go green for a day. But real investors, real analysts, and smart people like you watching BullionIQ know that price moves are only the surface. Under the surface, something much bigger is happening. The Federal Reserve recently discovered that hedge funds are holding far more U.S. Treasury bonds than official reports suggested. Not millions, not billions, but nearly $2 trillion worth of treasuries hidden in complex transactions. Imagine thinking someone has 4 apples, but later you find they actually have 20 apples. Big difference, right? That's what happened here. And this was not a tiny accounting mistake. This was a financial shadow game using leverage and something called the basis trade. Let me explain this simply. Hedge funds buy real treasury bonds and at the same time short or bet against treasury futures. They hope to profit when the prices match again. It sounds simple, but the danger is how they fund it. They borrow massive amounts of money using the repo market, basically taking short-term loans against those bonds as collateral. But here's where things get messy. Those same bonds are then used again and again by different firms as collateral. This is called rehypothecation. In simple words, The same dollar gets counted multiple times. The same asset gets pledged again and again. And that means nobody truly knows who owns what. It is like 5 people showing the same house document to different lenders and taking multiple loans on the same house. Eventually, the truth comes out and someone loses everything. If these hedge funds are forced to unwind their trades suddenly because markets panic, liquidity dries up, or interest rates move unexpectedly, the whole system gets shaky. Treasury markets could swing wildly. Borrowing costs could jump. Banks could panic. And the Federal Reserve? Well, it becomes blind to what's really happening because the real risk is hidden in shadows. Think of it like flying a plane with fake instruments. You think everything is normal until the ground suddenly comes fast. That is the level of risk quietly building right now. Combine this with rising interest rates, global debt pressure, and geopolitical stress, and you have the recipe for what investors call a global margin call. That means everything that is built on debt and leverage starts shaking. We saw a hint of this in crypto when billions in leverage positions were liquidated recently. If you held your XRP or your crypto spot in cold storage with no leverage, you simply watched the storm pass. Yes, price dipped. Yes, it feels uncomfortable. But you survived while leveraged traders got wiped out. The same thing is beginning to happen in traditional finance. It starts quiet, then suddenly everything accelerates. But here is the key difference today. This time, real alternatives exist. Gold and silver are returning as traditional safe havens, but blockchain is now part of the safety trade too. Institutions are preparing for digital value transfer at scale. Tokenization is not a buzzword. It is already happening. Money market funds, bonds, and soon, global currencies are moving to blockchain rails, and XRP is positioned directly in the center of that transformation. This is not about hype or moon talk. This is about infrastructure, banking rails, settlement systems, and compliance-ready crypto utility. More people are waking up to this every single day. When the old system shakes, capital will not disappear. It will move. Historically, it moved to gold. Now it also moves to crypto ecosystems that can actually handle global value. So while shadow banks and hedge funds quietly wobble, while mainstream media stays silent, and while the old guard hopes nobody notices the cracks, we are here early. We are aware. We are preparing, not panicking. The system is not collapsing, it is transitioning. And those who understand this shift will be positioned smarter than 99% of the market. Stay focused, stay educated, and stay ready. Write in the comments if you've understood this so far, and let me know you're here with me. Now that we've understood how hedge funds and shadow leverage are building hidden pressure in the system, let's move to the next layer of this story, the real-world fallout. Because when financial cracks start forming, they don't stay on paper. They show up in real properties, real businesses, and real people's lives. We are already seeing that. Let's talk about how small banks, private lenders, and real estate markets are reacting as pressure rises, and what it means for the next phase of this financial cycle. You've heard the saying, real estate never loses. But right now, parts of the real estate market are breaking, and not in a slow way. We are seeing multi-million-dollar apartment complexes financed in boom times collapsing in value because the owners can't pay the loans, repairs can't be funded, and tenants are walking away. A $21 million finance property selling for $1.5 million is not a normal event. That is the sign of a credit system that stretched too far and is now snapping back violently. Private loan portfolios tied to housing deals are going bankrupt. Hundreds of homes in cities like Baltimore are entering foreclosure after being bought at inflated prices with easy credit. Water bills unpaid, properties abandoned, values falling fast. These are not isolated cases, they are early warnings. When money becomes expensive and debt becomes heavy, weak hands fail first. Private lenders chase returns, lend too aggressively, then suddenly get caught when cash flow dries and borrowers fall behind. Small banks holding risky loans to these lenders get stuck. They cannot sell, they cannot recover, and they cannot hide losses forever. This is why you see sudden write-downs, surprise bankruptcies, and big names stepping aside quietly. It starts in the shadows, then moves into public headlines. That is what is happening right now. So, what comes next? The first stage is denial. It's just one case. Then suddenly the system admits, actually, there are more. We saw this pattern in 2008. People forget that before the housing crash became global news, signs were there for months. Certain lenders were failing, certain banks were writing losses, but most ignored it because markets kept moving and people hoped things would fix themselves. Hope is not a strategy in finance. Awareness and preparation are, and like we talked earlier, big institutions are already preparing. They will let smaller players take the hit, then step in and buy distressed assets for pennies. This is how power consolidates in finance. Winners do not panic. They position themselves calmly. You and I are here to learn and act early, not react when it's too late. Meanwhile, in the middle of all this, What is the Federal Reserve doing? Raising interest rates aggressively. That means debt becomes harder to service. It means refinancing becomes expensive. It means weak balance sheets break faster. Some people think the Fed is doing this blindly. Others think they know exactly what they're doing, forcing weak hands out, clearing the system, and preparing for a new financial foundation. Whichever truth you believe, the result is the same. Liquidity gets tight, risky credit breaks, and only strong assets survive. That's why long-term investors don't run from volatility. They prepare for opportunity. Look at crypto. Recently, billions in leverage positions were wiped in hours. Derivatives traders got liquidated. People who chased hype and borrowed too much got crushed. But what happened to disciplined holders? They felt the dip, but did not get wiped out. This is the same pattern across markets. Those who use excessive leverage get punished first. Those who hold strong positions survive and gain. That's why staying unleveraged, staying patient, and staying informed is not weakness, it is strength. And in the middle of this global financial tension, blockchain adoption is speeding up. Banks, fintech firms, governments, and asset managers are openly discussing tokenization, digital assets, real-time settlement, and cross-border systems. Ripple, XRP Ledger, and regulated stablecoin platforms are entering the picture not as speculation but as solutions. When traditional rails slow down, new rails rise. That is where this whole story is going, from shadow debt collapse to blockchain settlement rise. You are watching the system change in real time. Most people will realize it after the fact. You are seeing it now. So, stay with me, stay calm, and stay strategic. We do not fear cracks. We study them, we understand them, and we position ourselves for what comes next. We have discussed how hidden leverage, real estate breakdown, and tightening liquidity are quietly reshaping the financial world. Now let's go deeper into the next phase, the restructuring of money, flow, and power. Because when credit cycles tighten, the system doesn't just break, it reorganizes. And in every large reset, wealth does not disappear, it transfers. From those who panic to those who stay prepared. From weak institutions to strong ones. From old infrastructure to new rails. That is exactly what is happening right now. And most people are still distracted by price charts instead of looking at the mechanics beneath them. If you understand this phase correctly, you stop reacting emotionally to market drops and start thinking like a strategist, like a bull quietly waiting in long grass instead of a trader chasing noise. Look at capital behavior. Big players are not leaving markets, they are rotating. Cash is moving from speculative areas to foundational assets. Institutions are quietly increasing exposure to hard assets, real estate land, not over-leveraged buildings, gold, tokenized treasury products, and regulated digital infrastructure. What does that tell you? The system is preparing for a world where liquidity becomes controlled, digital, traceable, and real-time. When systems tighten, transparency becomes valuable. When volatility rises, stable yield becomes king. Tokenized assets are not a crypto dream anymore. They are about access, security, and global movement of capital at speed. That is why huge firms are building digital asset divisions, even while the public sees crypto volatility and thinks the industry is collapsing. Noise fools the masses. Structure guides the elite. And here's the interesting shift. Instead of relying on traditional banks for all financial flows, we are entering a stage where blockchain platforms, fintech banks, and digital custodians share the money pipeline. That means settlement systems are becoming hybrid, part traditional, part decentralized, part institutional blockchain. People who think crypto is only about trading coins are missing the point completely. The power is not in price moves, it lies in settlement rights. Who settles money, how fast, and under what rules. Whoever controls settlement controls liquidity. And whoever controls liquidity controls the financial world. That's why from Wall Street to London to Dubai to Singapore, digital asset infrastructure is expanding quietly. You are not early by accident. You are here because the world is shifting, and those who pay attention will be on the right side of history. Now let's talk investor psychology, because this part is critical. During these transition phases, most people make the same mistake. They panic on dips, chase pumps, jump between coins, follow social hype, and forget the big picture. Wealthy investors do the opposite. They build positions slowly, they accumulate during fear, and they avoid leverage unless the direction is clear. They do not care about temporary volatility because they are focused on ownership, not noise. Think about Bitcoin and XRP holders who understand utility, liquidity rails, institutional adoption, and macro cycles. They may feel volatility, but they're not shaken out. Meanwhile, short-term traders get liquidated again and again. These cycles are designed to transfer assets from emotional hands to disciplined ones. The market does not reward excitement. It rewards patience, intelligence, and structure. Another thing to understand, the world is moving toward regulated digital currencies. That does not mean decentralization dies. It means the financial system is entering a hybrid era where public and private digital systems coexist. Think commercial bank tokens, tokenized treasuries, real-world asset platforms, stablecoins backed by reserves, and eventually CBDCs connecting cross-border rails. Crypto is not fighting the system. It is merging with parts of it, upgrading it, and replacing inefficient pieces. Smart investors are positioning for this convergence, not arguing about which chain wins or loses. The real question is, which networks, assets, and technologies sit at the intersection of global money flow? Those are the assets with long-term power. And as this shift accelerates, volatility increases. Why? Because transformations are never smooth. Old systems defend themselves. Regulators tighten rules. Speculators panic. Opportunists attack weak structures. Headlines change sentiment quickly. But beneath the noise, infrastructure keeps building. Think long-term, move smart, hold knowledge first, assets second. There will come a moment where the market flips from fear to acceleration. The people who use this phase to study and position calmly will be ready. Up to this point, we've built a full picture of the financial world shifting beneath the surface, from leveraged markets cracking to institutions quietly preparing for a digital money era. Now it's time to step deeper into the transition phase where the real battle begins: trust, liquidity, and control. Whenever the global system changes, there is confusion first, fear second, and clarity last. Right now, we are in the fear plus confusion stage. People can feel something big changing, but they don't fully understand what it means. Markets get emotional in this phase. Narratives swing fast. And most investors get shaken out not because the opportunity is gone, but because they misread the environment and react emotionally instead of strategically. Your edge is staying rational when the world becomes noisy. That's how wealth is built during transitions like this. Let's talk about trust. For decades, the system relied on traditional banks and financial intermediaries to manage value, but cracks in trust are showing everywhere. Banks failing, funds hiding leverage, real estate deals collapsing, retail investors losing faith in old systems, even governments acknowledging weaknesses in cross-border settlement and inflation management. This loss of trust doesn't just disappear, it transforms where people place confidence. And right now, trust is slowly moving toward transparent systems, programmable assets, and digital rails backed by real liquidity. This isn't hype, it's necessity. When traditional plumbing leaks, you don't ignore it, you build a new pipeline. Blockchain isn't a trend, it is the new pipeline. Look at liquidity now. Liquidity is not disappearing, it is shifting. Old leveraged liquidity built on speculation, cheap money, and shadow funds is getting removed. Now liquidity is moving to regulated structures, institutional custody, and tokenized settlements. It's the difference between wild river flow and engineered canals. Both move water, but one is predictable, controlled, and designed for scale. That's where we're heading, a world where capital movement becomes faster, cleaner, and tracked. This is why major asset managers, treasury platforms, central banks, and payment companies are building digital frameworks. Crypto doesn't win by fighting banks. Crypto wins because the world needs better rails and the tech is ready. But every transition has resistance. Old power structures don't give up control easily. Expect tighter regulations, market manipulation, coordinated fear messaging, and sudden volatility. We already saw examples: aggressive liquidations, regulatory headlines, coordinated sell pressure. These events don't signal the end of crypto. They signal the system testing weak hands before major adoption. When the world upgrades, it doesn't happen calmly. Pressure is part of progress. Investors who understand the macro picture don't get scared by turbulence. They recognize it as positioning time. That's why patience and structure are more valuable than speed right now. Now let's shift from market mechanics to mindset, because mindset is what separates survivors from casualties. In times like this, average investors say, "I'll wait until it's safe." But by the time it feels safe, the opportunity is gone and institutions already own the prime positions. Wealth doesn't come to those who wait for comfort. It comes to those who prepare before clarity. Notice the behavior of strong hands right now. They accumulate quality assets slowly. They research deeply. They reduce leverage. They manage risk. And they don't let short-term panic rewrite long-term conviction. They know we are in accumulation territory, not panic territory. Whether it's Bitcoin, XRP, or other utility assets, the principle stays the same. Value rises when utility meets adoption and liquidity flows in. We are entering that corridor. And here's the important shift for you. Stop thinking like a trader chasing signals and start thinking like an investor positioning for a system reset. Wealth in new eras does not come from shortcuts. It comes from awareness, discipline, and time in the right assets. You don't need to predict every move. You only need to understand the direction of the world. And that direction is clear. Digital value, instant settlement, global rails, institutional custody, tokenized real-world assets, and blockchain-based financial infrastructure. We are early, but not forever. Breathe, observe, accumulate knowledge, and position wisely. The noise will pass, the future will arrive, and those who stayed steady through uncertainty will write the next success stories. We have walked through the global financial shift, the silent cracks forming in traditional markets, the tightening liquidity cycle, the rise of digital asset rails, and the mindset required to navigate transition periods like this. Now we arrive at the final and most important part, the positioning of the individual investor, meaning you. Because understanding the system is only valuable if it translates into your actions, your patience, and your long-term vision. Change does not reward the loudest, the fastest, or the most emotional. Change rewards the prepared. And right now, preparation is everything. This moment in history is not ordinary. Markets are repricing the old world while quietly valuing the new one. And those who remain calm, informed, and strategic will benefit from this generational shift. Let's put one thing very clear. You don't need to be perfect to win in this era. You don't need to catch every dip, predict every move, or chase every trend. You simply need conviction in a world where most people lose it. Remember, during financial transitions, the majority misinterpret noise as truth and temporary events as permanent outcomes. They jump out at fear and jump in at excitement. That cycle only creates losses. True investors operate differently. They understand the arc of change and hold positions with clarity and patience, not panic and hope. You are building the mindset that separates wealth builders from market casualties, and that alone puts you ahead of millions. Now let's talk practicality, because knowledge without structure is just theory. If you are watching these macro signals unfold, tightening banks, distressed real estate portfolios, institutional digital infrastructure, blockchain settlement rails, tokenization, your job is simple. Position quietly, accumulate slowly, manage risk intelligently, and educate yourself continuously. Do not try to get rich overnight. The greatest wealth cycles reward those who survive the turbulence, not those who sprint into the storm without a plan. If you hold Bitcoin, hold for utility and scarcity, not hype. If you hold XRP or other utility assets, hold for adoption and settlement use case, not price excitement. If you diversify into other strong fundamental projects, do it with research, not emotion. This is not gambling. This is long-term positioning in a transforming world. We must also recognize another important truth. Fear will intensify before clarity arrives. Financial media will shout confusion, markets will shake weak hands, big players will create volatility to position themselves, headlines will be dramatic. But remember, every major financial transformation in history looked dangerous before it looked obvious. The internet, smartphones, electric vehicles, fintech, early believers looked crazy before they looked brilliant. Blockchain is following the same curve. You are simply choosing to see the future before the crowd does. That's not risky, that's intelligent. The risky path is ignoring signals and waking up too late. And now, a mindset reminder for you personally. Stay grounded. Don't compare your journey with anyone else's. This is not a race, it is financial discipline. Understand your goals, build slowly, stay patient, and don't let temporary volatility steal your long-term vision. Markets punish impatience and reward clarity. Even if the world looks unstable, remember, change always looks like chaos before it looks like progress. And you are not here by accident. You've chosen to learn, study, and think like a long-term strategist. That decision alone creates a different future for you. So here is your moment. Take a breath, stand firm, and appreciate where you are. The majority chase confusion. You are building conviction. The majority panic during volatility. You are learning to see opportunity. The majority follow headlines. You are following strategy. This is the mindset that builds wealth. And as your host on BullionIQ, I am proud that you stayed through this full breakdown, absorbed the bigger picture, and committed to your growth.